Hello, welcome to another video from Anonymous. Today I shall be taking you through December 14, Section B, Question 2 for F7 Financial Reporting. Now this question is about a company called Candy, and you're presented with a trial balance and various adjustments. Overall, when reading the requirements, it's testing you partly on an SPL section with an adjustment to retained earnings, and then the preparation of the statement of financial position for the year ended 30th of September 2014. Now, as mentioned previously with F7 questions, it's a good idea to read through the content and material and break down exactly what's required. So just to run you through from the top. So we have Candy here, prepared with the draft statement of profit and loss for the year ended 30th of September 2014. Down below we're given a trial balance with various balances, so we've got the equity shares, retained earnings, etc. Underneath, interestingly, we have three different adjustments. So the first adjustment is about a loan note that was issued on the 1st of October 2013. So if we look through, it's issued beginning of the year, so we don't have anything to do with mid-year in terms of unwinding of financial costs. Here. And then we're told interest of 1.8 million was paid on the 30th of September 2014. So this is paid at the year end, which essentially means it was paid in arrears. And the loan is redeemable on the 30th of September 2018 at a substantial premium, which gives an effective interest rate of 9% per annum. No other repayments are due until the 30th of September. Now, if we look above, it said it's incurred issue costs of 1 million, which were charged to the profit or loss. If we look under IAS16 loan notes, we're actually supposed to deduct that 1 million in value off our total value of loan notes when accounting. So we'll come to this adjustment a bit later, but bear in mind, being asked to adjust for retained earnings, we're likely to add this back to our retained earnings because we have deducted it from our profits in the P&L. The next note is about non-current assets. So non-current assets always tend to come up, and so do tax, which you'll see in the next one. So these are two the areas which are very vital to learn, and also once learned and practiced, they are quite easy to do. So non-current assets. The first is about a property that has increased significantly in the recent years, and on the 1st of October 2013 they decided to do a revaluation. Note, it's the 1st of October 2013, so this is at the beginning of the year. It's very important in revaluation questions that you identify whether it's the beginning or the end of the year, because this affects your depreciation charge within the year. So after coming back, they've accepted a revaluation report where the land's at 8 million and the building's at 39 million. And it then goes on to tell us, which is useful for our depreciation calculation, that there is a remaining useful life of buildings of 15 years. Note, as we're asked to prepare a statement of financial position, you expect possible transfer to retained earnings for your revaluation reserve. However, we have been told that this isn't the case. However, it will give rise to a deferred tax liability, so this will play part in your overall tax balance further down. And tax rate of 20%. Plant and equipment depreciate 12.5% on a reducing balance method, so remember our carrying values and reduction of 12.5%. Remember, it's quite important to remember your carrying values and you don't do this off cost. A common mistake can be to do this off cost just because people see the straight balance and reduce. No depreciation has yet been charged of any of the non-current assets. That is important for our retained earning adjustments, because there has been no depreciation charge essentially to cost of sales in your P&L, so we'll have to account for this when we do our retained earnings adjustments. Further down, we're told there's a provision of 2.4 million required for the current tax year. So this would be a provision balance in our statement of financial position under current liabilities. And we're told that there is a possible under or over provision in the trial balance, which we'll come to in a second. And Candy has a further taxable temporary differences of 10 million as at 30th of September 2014. So this is your taxable temporary difference multiplied by your tax rate gives you your deferred tax. Okay, so we've read through and we know where we're going to be affected. We appreciate the fact that we're going to have a tax expense also here, which will be an adjustment to our retained earnings. So just to recap, as you'll see up in the pro forma here, we've got a loan note issue, loan note on finance costs, depreciation in buildings, depreciation of plant and equipment, and tax expense. Okay, so with the general retained earnings adjustment, would start with your retained earnings balance up at the top and work down through the notes that affect your overall balance. So here we're going to have three workings. Working 1, which I've denoted to loan note, working 2, which is generally always your pro forma of PPE, and working 3, which is always referred to as your tax working. Now, for this first part, we don't necessarily have to do every bit of the calculation to receive the adjustment to retained earnings. However, if we do the whole calculations now, it's going to make our whole statement of financial position section a lot easier. It's best to just get it done whilst you're focusing on that section. So let's start with the loan note. Now, we were told here that there was that 1 million expensed. We need to reduce that off our carrying amount, this 29 million here. This will be represented in our statement of financial position at that balance, plus the additional interest, which we'll come to in a second. So we're told that it was paid in arrears, so we're going to have an effective interest rate of 9% on our carrying value of 30 million. Sorry, of our 29 million. So we have a 9% of our 29 million. This means on your loan note calculation, as it's in arrears, you start with your carrying amount plus your interest rate, deduct what's paid, and that will get you as an overall sum to what you must represent in your statement of financial position. This difference here of 810 is your additional finance costs added to your loan notes. The effective interest rate you see here is your finance costs in your P&L. So we'd come back up to our retained earnings. We'd then add back the 1 million that was expensed for the issue costs of the loan note, and then we would less the finance costs which have yet to be realised in the P&L. These are the finance costs at the effective interest rate. It is important to remember that you pay at your 6%, however your costs are at your effective interest rate. So once we've done that, we've got two values here. We're aware of what we're going to represent in our statement of financial position. We'd move on to our PPE workings. So we know our adjustment for retained earnings, we're going to have a few areas of our P&L affected, which would be your cost of sales with regards to depreciation for PPE, and we'd also have your other comprehensive income. However, this does not affect your retained earnings. This is based under your profit after tax, so we're going to put that aside for now and just focus on the depreciation and the revaluation amounts. So starting with land and buildings, as discovered here, we have two values up in our trial balance which tell us overall our land and buildings at cost were 55, and at the 1st of October, so the beginning of the year, we had accumulated depreciation of 20 million. So we know our carrying value is 35 million at the start of the year. We then went on to revalue our land and buildings at a combined cost of 8 million for land and buildings at 39 million. So altogether we had 47 million. This gives us a gain on revaluation of 12 million. Now, this gain would be represented in your revaluation reserve, which we'll come to later with the statement of financial position, and also in your other comprehensive income. However, we are also told that it gives rise to a taxable temporary difference, so we deduct the taxable temporary difference off your revaluation gain in your revaluation reserve. So we then go on and we have the revalued amount of 47 million less the depreciation on buildings. Buildings only. Don't forget, we don't depreciate land, we depreciate the building. So here we have our 39 million from the revaluation of our buildings divided by 15 to give us a year's worth of depreciation for that building for the year ended 30th of September 2014. Deducting this from our overall land and buildings value, we come down to a carrying value of 44,400,000. This is our carrying value for land and buildings in our statement of financial position. Moving on, we then are told a plant and equipment is depreciated at 12.5% per annum on a reducing balance method. So, as earlier, we need to figure out what our carrying value at the start of the year was. So, looking down, we've got a cost of 58,500,000 and a depreciation accumulated at the start of the year at 34,500,000. We deduct the accumulated depreciation from our cost to give us our carrying value at the start of the year. Remember, our reducing balance method is based off the carrying value, so we do 12.5% of our 24 million to give us 3 million. We deduct this from our 24 million to give us a carrying value of 21 million. So here we have identified there's depreciation charges of 2,600,000 and 3 million for our adjustment to retained earnings, as these would be charged to cost of sales in your P&L. So we'll go back up to our question and we'd enter in our 2,600,000 and 3 million. And then we know that there's a remaining tax expense for calculation. So for our tax expense, the tax expense works in a very simple way. So we have to first work out our deferred tax movement for the year, because this will be our movement to the P&L. Once we've done that, we then also have to represent this tax pro forma here. This is a pro forma that's always used. What we do is our current year estimate, so that's the 2.4 million that you're given. Remember, this will represent your balance in your statement of financial position. However, in the P&L, there may represent an under or over provision from the prior year. If we have over provided, we've provided too much, so there we deduct from the current year balance. If we have under provided, we have not provided enough for the prior year, so we add the current balance. So in this case, we go up and we look at our deferred tax, our current tax note. We see it's in the credits column. Now, a little trick to remember for this is if your tax is in your credits column, it's CROP, C-R-O-P, so credit over provision. So if it's in the credit column, we have over provided, so therefore we deduct this from our current year estimate, and we then also deduct our deferred tax movement. We have actually had a reduction in deferred tax for the year based on our temporary differences. We'll come to the revaluation gain shortly. So once we've done this, we get our tax expense for the year of 800,000. So we know that this is what affects our retained earnings, so we'll head back up and we'll add that in. Once we have taken our retained earnings per trial balance and then removed all additions of depreciation, tax expense and loan note finance costs, and then added back the issue costs, we get an adjusted retained earnings balance of 9,490,000. So as you know, significantly different from the initial start. However, we've now corrected this. Remember, your retained earnings will then be represented in your statement of financial position, which we'll come to now. So, moving on. That part, section A, was our adjustment to retained earnings, and they always sort of seem to test an area which will then affect the next part. If you are struggling in the exam, a bit of advice would be, if you're not sure what something is, just make sure you've got an overall figure here and you do pull it across to your next question. That will get you a mark. You might not have the value, but you've shown what you're doing in terms of method. So, moving on, we'll then look at the statement of financial position. As we all know, or should know by now, our statement of financial position is laid out with assets at the top, equity in the middle, and current non-current liabilities at the bottom. This should balance as total assets versus total equity and liabilities. I have balanced it here for illustration purposes. However, in the exam, I would advise not to balance. There's two reasons. Reason one, you don't get any marks for it. And also, it's a waste of time. Reason two, if it doesn't balance, you'll end up panicking, and it's likely that you might only have one small thing wrong. So just move on, forget about it, don't worry. Okay, so we start off and we'd lay out our pro forma, our non-current assets, PPE, current assets from the trial balance, equity. So in equity section we usually have share capital. There is share premium. In this case we don't have it, so we've not included. Revaluation reserves, retained earnings. Then we move on to non-current liabilities. So under non-current liabilities in this case, we've got deferred tax, 6% loan notes. Current liabilities, we'd have your current liabilities as it's represented TV, but however this could be your bank overdrafts, payables. In your current assets, remember, it would be your receivables, positive bank balances, cash or cash equivalents, and current tax payable. Remember, deferred tax is a non-current liabilities as it's not immediately payable, it's just on unrealised profits. Your current tax payable is going to be payable within a year, so it's under your current liabilities. So starting from the top, we have now done our workings, we've done the hard work here. So it's a case of pulling things from here and pulling it from the trial balance. So for our non-current assets, we have PPE, plant, property and equipment, and we know from our working too, we have a carrying value to be represented for land and buildings of 44,400,000 and a carrying value for plant equipment of 21 million. So here we'd enter into the brackets total across. You don't actually have to total across in the exam. If you've represented correctly here, you'll get the marks. The examiner doesn't give you marks for totaling up. He knows how to add up, he just wants to know your workings are correct. We then move on, as we know there's nothing else represented here from reading through the trial balance. We then move on to current assets. In a larger question you probably expect to have receivables as your current assets separately, with cash and cash equivalents being your bank. However, in this, as anticipate, as this is only 9 marks, they've given you your total current assets. We know that reading through here there's no adjustments to your current assets, so it's just a straight trial balance entry. So you just enter in your current assets from your trial balance. You'd get your total assets of 134,100,000. We'd then go on to our equity section. Again, there could be adjustments to this in other questions. However, in this question, as it's a 15 marker overall, it's just a straight pull from the trial balance. Remember, if you'd had a share issue within the year, rights issues, bonus issues, this could affect your share capital and also your share premium based on current market value. We then look at our revaluation reserve. Now remember, we did have a revaluation, interestingly, and we've already done the hard work here. So we've come up, we'll have a look, and we've got a gain on revaluation of 12 million, so we know this goes to our revaluation reserve. However, it does give rise to a taxable temporary difference, deferred tax liability. So we know that our revaluation is at 12 million, however our deferred tax liability of 20% is deducted here of 2,400,000. So this gives us an overall revaluation reserve of 9,600,000. And we are also aware that there's no transfer to retained earnings. If there was, this balance would then be cleared and moved across to your retained earnings. Retained earnings, so we did this in section A. Good 6 marks from it, so we just simply pull this balance from what we've calculated in section A and bring it down here. Non-current liabilities. We now move on. So non-current liabilities. We're aware that there's going to be a deferred tax from our workings. We know that our deferred tax movement based on the taxable temporary differences was 500. Sorry, I'll correct myself there. Sorry, our deferred tax balance. Be careful not to do what I've just said and do the movement. Look at your balance. Your closing balance was 2 million. Plus, you've then got an additional 2,400 from your equity section, from your revaluation reserves, which is the taxable tax liability on your revaluation gains. So your overall deferred tax balance to be represented in the statement of financial position will come to the addition of those two values, your closing deferred tax plus your revaluation gains, 4,400,000. We then have our 6% loan notes. Now, if you remember the calculation we did earlier, this would be our carrying amount of 29 million plus the difference between your effective interest rate and tax paid added to that 29 million. So overall, this represents 29,810,000. We now review our trial balance, just check again, is there anything that we may have missed? Nope. We've got interest payments which represent your movement for your loan note. And we then move on and say, right, this leaves us with our current liabilities. Current liabilities, again, as it's a smaller question, I anticipate they've just given it overall with no adjustments. They could give you adjustments, however, nothing present, so it's just a simple pull from the trial balance. Current liabilities pulled over and placed straight down here. You're getting easy marks by doing these trial balances, so a bit of advice in the exam would maybe just to pull across things that don't require an adjustment first, get the marks in, and then work on the rest. Current tax payable, working 3. So this is the tax that is payable within 1 year. Now, it's represented in working 3, however, we're told this in the question. A provision of 2.4 million is required for the current income tax and the profit for the year. This will be your tax balance for the year, your balance, statement of financial position of balances. So we'll pull this over, total up our equities and liabilities, and we get 134,100. And that is the end of that question. So as you can see, there's a lot of easy marks to be picked up from pulling across from trial balances, setting up pro formas, and just putting in these depreciation charges. So these sort of questions are the sort of things that will always test one side with the P&L and one side with the statement of financial position, and don't be thrown just because it says adjustment to retained earnings. That's an adjustment to your profits, it's an adjustment to P&L, so don't worry about it, just get stuck in, work on what you'd apply to your P&L extra costs and just work out whether that's an increase or decrease on your profits, and that's exactly what you need to do. Thank you for listening and stay tuned for more.